Welcome to the Explainer. Let's jump right into a really fascinating paradox. So, back in 1958, a young investor bought a five-bedroom house in Omaha, Nebraska for $31,500. Fast forward to today, he's worth roughly $140 billion, yet he literally still lives in that exact same house. You've probably guessed it, that man is Warren Buffett. Now contrast him with a guy you've definitely never heard of, an anonymous manufacturer in the American Midwest who makes absolutely nothing but standard, unglamorous cup holders for commercial vehicles. There's no brand, no social media presence, just 31 straight years of consistent cash flow. And he's worth approximately $40 million. You see, Buffett and this anonymous manufacturer run the exact same wealth system. It's quiet, it's totally invisible. And today, we're going to break down exactly how it works through mindset, mechanics, and momentum.
Okay, let's dive into this. The foundation of this entire system relies on understanding the core difference between looking wealthy and actually being wealthy. Notice the stark contrast here. On one side, we have what we'll call broke Brian. He's out there chasing consumptive assets, right? Luxury cars, designer watches, massive kitchen upgrades. Now, these assets generate a feeling, and hey, that feeling is very real, but they lose value the literal second you buy them. On the other hand, we have Smart Sam, acquiring productive assets, things like index funds, real estate, business equity. These assets generate an actual return. Honestly, the confusion between these two categories is exactly how new money disappears. Old, invisible wealth just doesn't buy things to signal status. It strictly buys things that produce income.
Here is our roadmap for today's explainer. First, the mindset of invisible wealth. Second, making your money work. Third, the mathematics of debt. And fourth, the compounding inflection point. Section 1, the mindset of invisible wealth. Unlearning American consumerism. So to actually keep the money we earn, we really need to unlearn a whole lot of standard consumerism. And to do that, we look to some powerful, deeply ingrained principles of Japanese financial discipline, starting with a concept called mitate. Essentially, this is the art of seeing what something else could be. It's the daily practice of looking at what you already own and asking yourself what else it could do before you go out and buy a brand new thing. Think about the classic avocado slicer. I mean, we spend billions of dollars on single-purpose gadgets that solve problems a simple knife already solves perfectly well. Mitate forces you to pause for just 60 seconds before hitting add to cart and ask, do I have something that does this adequately? Because adequate is free, and free leaves your capital available to invest. Look at the stark contrast between these two mentalities. The average American household is currently carrying over $11,000 in credit card debt. The average Japanese household, almost zero. Look at the default solutions for everyday problems. Here in America, the instinct is usually to just buy a specialized product. But in Japan, there's this great principle called uchimizu, which basically means trying the free solution first, like opening a window before cranking up the air conditioning. Or take osagari, which is the hand-me-down economy. Instead of buying brand new strollers and clothes that a kid is going to outgrow in literally 6 months, utilizing hand-me-downs saves massive amounts of capital that you can instantly redirect into something like a college fund. It is a completely different operating system for daily life. And that brings us to Giri. This translates to an obligation or a moral debt. In this framework, financial debt isn't just viewed casually as some handy leverage tool. It's treated as a literal weight on your character. It basically means you took something you hadn't actually earned yet. Treating debt this way naturally keeps your fixed costs permanently low. And as you probably know, when your fixed costs are low, your optionality, your freedom to take a risk, change careers, or absorb a bad year, goes absolutely through the roof. Section 2, making your money work. The mechanics of deploying capital. Now, what's really interesting about this transition is that we're moving from defense to offense, because saving alone, especially in a low-yield bank account, will almost never make you wealthy. We actually have to deploy that capital. So here's a highly realistic 5-year wealth plan. Step 1, your income is the engine. You've got to increase it. Step 2, and this is the secret weapon, save half of every raise. Psychologists call it hedonic adaptation when your lifestyle inflates to perfectly match your new income, which leaves you feeling just as broke as before. Saving half of your raise completely neutralizes that trap. Step 3, build your safety money, your 3 to 6 month emergency fund, so you never ever have to sell your investments in a panic. And finally, step 4, auto-invest the growth money. Look, earning $50 a year on $10,000 in a savings account is not going to get you to financial freedom, but pushing that capital into the stock market absolutely will. So where does that growth money actually go? Generally speaking, you have two broad paths.
dividend portfolios, and index funds. Now, dividend stocks are companies that literally deposit cash right into your account just for owning them. It provides incredible psychological stability because you get this steady cash flow without ever having to sell a single share. On the other side of the fence, we have index funds. These represent the entire broader market, and mathematically, they are superior. They offer maximum diversification, incredibly low fees, and historically higher total returns. Sure, they're kind of boring, but they are incredibly effective. But, and this is a big but, index funds do carry one specific vulnerability. It's known as sequence of returns risk. Imagine you rely entirely on an index fund, and you're using the standard 4% withdrawal rule, where you sell off a tiny piece of your portfolio each year to live off of. Now, if the market suffers a massive crash the exact same year you retire, you are forced to sell your shares at a significant loss, literally just to buy groceries. This risk is precisely why the psychological comfort of a steady, unsold dividend paycheck is so appealing to a lot of investors, even if their total lifetime return might end up being slightly lower. Section 3. The Mathematics of Debt. How the Wealthy Rent Money. Okay, earlier we talked about Giri and viewing consumer debt as a heavy moral weight. But get this. The truly wealthy don't avoid all debt. Instead, they view it as simply renting money. And the entire game of leverage comes down to this one simple equation: the spread. This is just the return your rented money earns minus the interest rate that the rented money costs you. So if you borrow money at 4% and use it to buy an asset that pays you 7%, you just kept a 3% spread on money that was never yours to begin with. Make sure the asset generates more than the debt costs, and suddenly, debt stops being a trap and becomes an absolute engine. Let's look at how this actually works out in the real world with some actionable strategies. At the most accessible level, you've got 0% balance transfers. You pay a small 3% upfront fee to move high-interest credit card debt over, effectively erasing a nasty 24% interest rate. That is an enormous, guaranteed spread. Then you have trade credit. Say a product business gets inventory on 30 or 60-day terms, they sell the product, collect the cash, and then pay the supplier. They use exactly zero of their own money, creating infinite leverage. Then there's real estate refinancing, where investors fix up a property, bump up its value, and pull their original cash right back out to go buy the next one. And underneath all of this, the foundation is your credit score. Improving it lowers the cost of every single dollar you will ever rent. And taking the concept of the spread to its absolute extreme, we have the buy, borrow, die strategy. This is the playbook used by the ultra-wealthy. Step 1, they buy appreciating assets, like stocks or businesses, and they never, ever sell them. Why? Because selling triggers taxes. Step 2, they live off their wealth by taking a line of credit against their portfolio. They borrow money at maybe 6% to completely avoid paying a 24% capital gains tax. The spread there is massive. Step 3, when they pass away, their heirs inherit the assets with what's called a stepped-up basis. That means the taxable value is legally reset to today's price, entirely erasing a lifetime of capital gains taxes. It's literally renting money to preserve generational wealth. Section 4, the compounding inflection point, surviving the boring years. Let's move to and see how this builds into our final phase. We've set up the mindset, we've deployed the capital, and we understand the math of leverage. Now, we just have to survive the psychology of waiting. Compounding is essentially like packing a snowball at the very top of a huge hill. In the early years, you are doing all of the work. You're packing the snow, your hands are absolutely freezing, and the hill isn't doing a single thing to help you out. This metaphor perfectly validates why investing your first $300 a month feels absolutely terrible and completely unrewarding. You are doing all the manual labor, and the market is giving you almost nothing in return. Let's look at the math for someone we'll call Mira. She invests $500 a month at a 10% average return. By year 5, she's manually put in $30,000, but the market has only added $8,000. It's mostly just her own effort. But jump all the way down to year 30. She has contributed $180,000 total, yet her account is worth nearly $1 million. Compounding, the market itself generated over $800,000 that she never had to work for. That right there is the snowball rolling down the hill. But here is the multi-million-dollar question. At what exact point on that timeline does the wealth machine actually turn on? When does the math flip so that the market is officially contributing more to your wealth each year than you are manually saving from your hard-earned paycheck? When does compounding stop feeling like a test of patience and start feeling like absolute power? The answer? It's somewhere right between year 12 and 15. That is the inflection point. That's the exact moment gravity just takes the snowball right out of your hands. You put your money in, you feel slightly bored for about a decade, and then quietly, the machine turns on. And suddenly, compounding starts feeding you way faster than you can feed it. Your only job is to not quit before you hit this magical window. And this brilliantly illustrates exactly why old money tracks wealth so differently than most people. It's the difference between income and net worth. Income is the flow of money coming in. It's so easily inflated by your lifestyle. But net worth, that is the stock of money accumulating. It is the true metric of real wealth. If you only manage your money by the flow, you're going to constantly feel the friction of those boring years. But if you focus on the stock, on the process of building the base, you can calmly navigate right on through to that year 15 inflection point. Which brings us to this incredibly powerful quote. Compounding doesn't fail most people. The timeline fails most people. The absolute worst financial decision you can make isn't picking a bad stock. It's starting late, or it's panicking and selling out of the market during a downturn because you got scared. When you do that, you break the chain. You literally reset the snowball right back to the top of the hill. So the crucial point is this. The systems of wealth we've discussed today are completely available to you. They don't require extreme intelligence, and they certainly don't require an inheritance, but they do require discipline. They require the mindset to use what you already have, the strategy to deploy your capital smartly, and the unshakable patience to survive those boring years. The only question left is, will you trade the excitement of looking wealthy today for the invisible patience of becoming wealthy tomorrow? Thanks for joining us on this explainer, and we will catch you next time.